You see, what has happened in the meantime is the Treasury General Account, that is the Fed, the Treasury, have been issuing bonds to top up their general account, which is taking cash out of the system. So they've withdrawn about 500 billion since July the 16th. That has hit risk assets somewhat. And of all the risk assets, the one that's most susceptible to liquidity is crypto. So crypto got that, which has been this choppy. It went up. Alts have been outperforming. Then they came back down again. And it's been just a bit sloppy. Nothing more than that. There's been nothing really adverse going on. Just a bit sloppy. Top of the range for ETH, top of the range for Sol. Tried to break out, came back down. Fine. But generally it's because they're sloppy because liquidity has been taken out very fast. The liquidity withdrawal stops about here. We're at the point where we don't need to withdraw any more liquidity and the Treasury General Account is topped up. Okay, so that negative thing has gone probably today, tomorrow, this week, next week, whatever. It's gone. And we start to see that liquidity will play catch up. Does it catch up to this chart? I don't know, but it always has done in the past. And I'll come on to the past in a sec. Okay, then we go to the NASDAQ. It's actually done really well in recent times, following this beautifully, because 97% of NASDAQ's performance is explained by this. But look at this in the past. NASDAQ can do this shit too. This is all based on flows. So NASDAQ is getting consistent flows based on this technology bid that's going on. And it's sucking in capital from foreign investors, etc. And Bitcoin just has been sloppy because it's had less of the capital that was available. So it's the marginal capital. As the marginal capital comes back, Bitcoin outperforms. And I'll show you that. So here is the chart of Bitcoin versus NASDAQ since 2022. So Bitcoin's been outperforming NASDAQ. That's its job. That's what it does. This is why we own it. And it does these kind of nice corrective patterns up, corrective pattern up. And what we've done is we're back near this old 2 standard deviation favorite place of ours, where generally Bitcoin outperforms. Now, I've noticed many of you, and I noticed on X, are all like punting tech stocks and saying, well, crypto, it's boring. It's changed. The market's changed. They're all different now. It's not. Just shit happens. Short periods of time. So that happens. And what will happen is the more of you, I even heard from good hedge fund in crypto, they're like, yeah, we're thinking we're just going to trade more stocks now because, the crypto market's not the same. So what they're suffering from is this. And what will happen is this. It's so fucking obvious. And I use DMARC. This is on Bloomberg. I got told off for Tom DMARC for using a fake version, but I use this anyway. And I've paid for DMARC for 20 something years, 25 years. We've got the 9-13-9 pattern. So that starts to suggest that Bitcoin will outperform technology. Maybe technology corrects a bit. Bitcoin does okay. And then Bitcoin starts outperforming. And I would suggest that alts will outperform. Another interesting chart for you, not related to the liquidity flow, but located to when people start getting fixated on a particular type of market. S&P in the 90s into 2001 versus S&P today has been extraordinarily similar. And that's this technology narrative, the AI narrative, and how it's taken hold there. So just an interesting chart. Whether it holds forever, I actually doubt it. I think this probably comes up, then comes down. I think this whole cycle lasts a bit longer. So why is Bitcoin sort of not wildly off to the races yet? And it's this chart. Bitcoin is basically, this is a detrended Bitcoin. And it's basically the ISM, which is the business cycle. Remember, we've always said it's the business cycle stupid. It is always the business cycle stupid. And all of these people who claim it's the 4-year cycle based around this and that, they don't understand the fundamental of what the business cycle is, why there's a 4-year cycle in everything. And we've explained it. And we'll go through it in great detail tomorrow in our Everything Code presentation. But basically, it's following the ISM. And rates have been following the same pattern. You see, rates should have come lower. They need to come lower because we need to roll the debt. We've talked about this. That's part of the Everything Code, fundamental part. And ISM because rates are so high, has meant that Main Street has been screwed while Wall Street's made money from debasement. Earnings versus scarce assets. This is the issue that they need to solve, and they need to get rates lower. They get rates lower. Why? Why do we have an elongated business cycle that looks like virtually no other real other time? It's because, and I only just found this out redoing the work on the Everything Code recently, is that in 2021-22, they actually extended the maturity of the debt from 4 years to 5 years. So that extension of the maturity of debt has pushed out the business cycle a year. The 4-year cycle this time around is a 5-year cycle. We don't know what the next one will be until we see where they all end up getting refinanced, whether it comes back to 4 because they managed to get some stuff at the long end, or whether they shorten it because everything's in the short end. We don't know yet. But this one is a 5-year cycle. And this is what it looks like. The 5.4-year sine curve, 5.4 years is the exact average weighted maturity of the debt. And it tells us the ISM should peak by 2026. We think liquidity probably peaks before that, as the rate of change of ISM changes and the rate of change of liquidity changes. Our best guess remains well into 2026, probably Q2. We'll have more information on that in due course. Part of that is driven by our financial conditions index. This leads the ISM by 9 months. It says in 9 months' time, we're in September, so this is June, the ISM will be 56.3. That's still not racy. At the tops of the cycle, it actually gets usually a bit higher than that. It usually gets to sort of 58, maybe 60. Regardless of where we get to, in 9 months' time, the ISM will be that. That's June of next year. That tells you the cycle, probabilistically speaking, will end up going up until Q2 next year. So remember that M2 chart? I see a lot of bullshit, again, as ever, on X saying, well, it doesn't work. It's never really worked in the past, blah, 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 blah. So here is what it did with the 12-week lead applied in what we think is the most similar cycle to this one, which is the 17 cycle, 16, 17 cycle. And back then, Bitcoin followed it really well. It worked really well. And in fact, Bitcoin peaked after Global M2 peaked. But you can see how well these things work. They're not perfect. Look at all of these divergences where you're losing your shit saying, well, it's doing different things. It's underperformed here. Bitcoin outperforms here. It's underperformed here. Why is it underperforming? In the end, it's all bloody noise. So that's what we're saying. The other one is when we look at a similarity of that pattern, we kind of see that 2026 is more 2017. And that somewhere contextually there's this extra year, and it feels like it's all to play for. And it's very remarkably similar pattern. Again, we're not looking for this to repeat perfectly. We're giving contextualization that if we go longer, the price is going to go higher than people expect. That's a function of that log regression channel I often show you.